This is a mantra or a credo that I've held for quite some time. So in my view, he who owns the customer relationship tends to clip most of the alpha, tends to clip
Ooh,
most
that's
of
hot.
the value in the value chain.
Is this thing on?
Yesterday's price is not today's price.
Thank you, Fat Joe, and welcome to Run the Numbers, where I interview world-class CFOs, operators, and the investors who fund them on how to get the most out of your company's performance. This podcast is a playbook of sorts for ambitious people in the worlds of finance, strategy, and operations. Today, my guest is Alex Song, the VP of Finance and Capital Markets at Ramp. On this episode, we cover unique balance sheet and liquidity considerations for a payments company that typical B2B SaaS businesses don't need to worry about, how finance brokers risk within a company and how it changes depending on the product you are selling, like credit cards, what terms like duration mismatch and counterparty risk actually mean, how owning the customer relationship in any business results in the most favorable unit economics, frameworks for thinking about the trade-offs between risk and return, what it was like trading mortgage-backed securities after the banking collapse in 2009, wild times, and about a dozen crazy stories from his past life as an investor. Alex currently holds the Run the Numbers title for the most interesting guest. This guy has lived like 9 lives, getting to work on some of the most unique and compelling investment stories before his time at one of the most unique and compelling unicorn startups. You'll hear Alex tell stories about investing in Colombian litigation claims, rough diamonds, seismic shipping vessels, and other assets you would have never thought about securitizing. For anyone who likes to nerd out on business models and likes to dissect risk and return profiles, this is the episode for you. All this and much, much more after a short word from our sponsors. Cash is king. As the CFO of a SaaS company, I know firsthand how important it is to maintain a healthy AR balance. If you can't effectively manage cash, you can't service debt, make payroll, or invest in growing your business. That's why I'm so excited to partner with the sponsor of today's episode, Maxio, the leading billing and financial operations platform for B2B SaaS. Maxio helps top SaaS companies like Chili Piper, Crunchbase, and Stack Overflow get cash in the door faster by automating collections and dunning. Gone are the days of manually chasing down invoices. Join the 2,500 plus subscription businesses using Maxio, formerly SaaS Optics and Chargeify, to eliminate revenue leakage and streamline order to cash. It's never been easier to get paid. Visit maxio.com/run the numbers to supercharge your financial operations in 2024. Not only does requesting a demo using the Run the Numbers link help support this podcast, ya boy, you'll also receive a 10% discount on your first year with Maxio. Woo! That's maxio.com/run the numbers. That's maxio.com/run the numbers. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. Alex, what's up, man? Welcome to the Run the Numbers podcast.
Absolutely. Thanks for having me.
I've been pumped to have you on because I've been trying to figure out how this whole payment space works, and I'm chalking you up to an expert. And so you were leading finance at Ramp, and I'm guessing there were some balance sheet considerations you had to keep in mind that someone working in finance at a typical B2B SaaS company, kind of my background, would not. Can you speak to how your business model impacts the liquidity that you need to have on hand?
Yeah, so, what's interesting, a little bit of context for, the listeners and the viewers. Ramp is a company that's been around for a couple of years, and there's a lot that the company does, one of which is it issues credit cards to cardholders, to businesses and to customers. Normally, when you facilitate payments, right, it's payment in, payment out. And it's generally a riskless business that takes very little balance sheet. There's always risk, right, because there's always frauds and regulatory and legal and whatnot. But generally, it doesn't require a ton of balance sheet. For a credit card issuer, though, think Capital One, Chase, Brex, Ramp, right? The kind of the laundry list of credit card issuers. You're actually extending credit. And so what that means is, even though you're facilitating payments, you still need to actually furnish the cash that's used to settle up with Visa or MasterCard or one of the big networks. And so
is furnish mean like not furnish your house? Like furnish, is that a fancy word just for the benefit of listeners? It means you have to like show it's in your account if you're fronting people the money?
Yeah, that's right. That's right. And so cash is literally leaving your account every day. And then on a monthly cycle or some other cycle, customers pay you back. And so there's a whole ecosystem where cash moves, right? And that's working capital. Like that's capital you just need to have available on any given, day-to-day basis, which is interesting and it's complex, right? Because I think I would say most businesses, right, you would invest in equipment, and that might be once every couple months, once every couple years. You would invest in payroll, right? Okay, so you need to make sure that on a bi-weekly basis, you have cash in your accounts to pay people salaries. And then for financial companies like credit card issuers, you just need potentially hundreds of millions, if not billions of cash available to settle up, right? With merchants and networks and other intermediaries and banks and whatnot. So it is working capital management at a very, very, high level and kind of a lot more scale.
Okay, I get it. And I thought like venture term loans were complicated. Do payment companies tap into credit? No pun intended, for credit cards?
Yeah, a lot of the times. Yeah, a lot of the times. It's pretty common. Credit is what makes the world go around. I think, where there is risk, I think there's a need for balance sheet. And so I think it is actually very common for players in the fintech space or the payment space to, have some sort of capital availability just to fund the business.
I love that line. Where there's risk, there's need for a balance sheet. I'm gonna put that on a bumper sticker or something in it. And it gets me into my next point here. Can you speak to how you think about risk management as a credit card issuer?
Risk is very important. Here's why, right? Payments generally is a pretty thin margin business, if you think about it, right? If you are a company that processes a lot of payments, your margin is measured in basis points, right? I don't care if you're Ramp or Brex or Wise or Revolut or, any of the other issuers or even Fedwire, right? Or RTP, all the different payment rails that are out there. Your margins that you're making are pretty skinny, as it turns out. And so what that means is what you want to do is you want to process payments or you want to issue credit or you want to do your job and then you want to make your margin. Depending on what that margin is, which again, generally tends to be, relatively skinny as a percent of the overall dollar amount, it means that anytime you take a loss, right, whether it's frauds or delinquencies or whatnot, you can wipe away, one loss can wipe away the income you make on the next 30 customers or the next 50 customers. That's pretty stark, right? If you think about it, if you put it in those terms. That's why risk is important, because margins tend to be pretty skinny. And so when you take a loss on the principal of the dollars you're moving back and forth, it just really, really impacts your P&L. Generally speaking, I would say in the fintech space or financial services space, risk appears in at least two different vectors. One is just frauds, right? People who steal credit cards or impersonating other people. That's thing number one. Thing number two is really credit delinquencies, right? So you extend credit and someone doesn't pay you back because they just don't have the money around or whatnot. So those are two big vectors that most people think about. But there's a ton of other vectors too that are usually a little bit more hidden. One is counterparty risk, right? That's just the guy you're doing business with, the guy who is maybe upstream in the value chain or maybe downstream in the value chain. They just go and disappear, or they misplace your funds. I mean, a lot of the discussion these days around the BaaS providers, right, with Synapse and Evolve and a few of these other folks, I think actually revolve around that third portion, which is counterparty risk. And then there's a few other vectors as well, but risk, because of how important it is to this industry, it's one that warrants a lot of thoughtfulness and consideration.
Alex, can you speak to what duration mismatch means?
Duration mismatch is basically the concept of having assets and liabilities on the balance sheet, and they occur in different durations, right? I'll maybe give you a very simple example. Let's say you are a company and you have a massive government contract and you're going to get paid by the government and they're money good, right? So that money is definitely going to show up. But let's say they only pay you once a year. Massive multi-million-dollar contract, you get paid once a year. That sucks because as a company, you need to make payroll every 2 weeks, right? And then you need to go and buy stuff, you need to pay rent, all of this stuff. And so that means for the whole year, you have no cash. There's nothing for you to do, right? And so even though on paper, it could look like you're a decent business, you're solvent, etc., you might have no liquidity, all right, to actually run the business. You have to lay people off, when you're actually running the business that way. So that's a very crude example, but that's really the foundation of what is an asset liability mismatch. In financial services, this is massive, right? This is massive because assets and liabilities is critical when you're thinking about working capital, managing the balance sheet, and making sure that you have available cash when you need to do that. Now that's really the role of like corporate treasury or someone like that in the corporate treasury space, and really understanding, okay, when I need to put cash out, because if I don't, there's going to be some issues, and making sure I have the cash in the bank that's available and that's liquid.
That's a great example. And it reminds me a bit about like the cash conversion cycle for companies that like actually make physical things, and how you can be a victim of your success in a lot of ways, where you can actually grow into the ground if you do have that mismatch between what you need to put into your working capital, like inventory, and then what you're getting out and actually getting paid.
If you think about like last March during the whole SVB crisis, right? You had a lot of companies that were extremely financially sound on paper, right? They had cash on the balance sheet, they had investments, they had T-bills, they had money market funds, all of that stuff. Well, when SVB kind of went under and there was all of that financial distress, a lot of companies found that they actually couldn't make payroll. Why is that? Well, for payroll, you need to put the money out, on a Thursday or on a Friday. I forget the exact date, for last March. But the problem was some of that cash was stuck, in a bank temporarily. And everyone was like, well, it doesn't matter because I have all these T-bills, or I have bonds, or I have stocks, or I have stuff in the corporate treasury. Why don't I just sell that to make payroll? And this is where, like, around the edges, people don't often think about the fact that some of these bonds and stocks and financial assets, sure, I can hit the buy and sell button today. A lot of these trades don't settle until T+2 or T+3, which means the funds aren't actually available for another 2 or 3 business days. That's actually a great example of asset liability mismatch for a bunch of companies last year, when they realized, wait a minute, our deposits aren't around, but it's okay because I can rely on this other liquid stuff. And then people realize, wait a minute, that's not actually as liquid as I thought it was.
And that's the part to me as a CFO that, like, on paper, I'm like, oh no, I'm good. But then you have to think about the real world implications of where cash actually sits at any given moment.
That's right. Which is also one of those things where, I advise, a lot of early, stage kind of founders.
Yeah.
And I would say, for what it's worth, in the early days of a company, that's actually not really something you need to spend a lot of time agonizing over. Keep it in a checking account. Make sure you have a strong counterparty. Just have it around. You don't need to dabble in, anything super fancy, buying T-bills and whatnot, until maybe you're a little bit bigger, a little bit more sophisticated, and you can actually invest the time in thinking about that.
Yeah, I always kind of laugh when a startup founder is asking me, like, what should I do about this sweep account strategy here? And I'm like, I think you should use the brain power to, like, go and build a product. You're not going to raise your next round because you were really great at sweep accounts.
That's right. That's 100% correct.
At a high level, how do you think about the finance function? We talked about company risk and return, but how do you think about the finance function as a trade-off between risk and return? What's your job there in brokering risk?
It's interesting, right? Because the first part of my career, the first 10, 12 years of my career, I was a hedge fund investor. I spent a lot of time thinking about risk and reward. You're taking risk. Hopefully you're making some money back, right, in your investment. What was interesting was maybe it took a little bit of that a little bit of that attitude, a little bit of that training, and that temperament to rep and kind of running and leading and building out the finance function there. Over the last couple of years, I think the biggest thing is that the finance team should be a partner, should be a thought partner, should provide the data and the guidance and the framework for making major decisions about businesses, right? The finance function doesn't need to make all the decisions, but should provide the framework and the basic underpinnings for decision making. And so what that means for the finance function is to make sure, well, one, the data is accurate, it's traceable, it's immutable, right? And that you are able to, reconcile, before, during, and after. The second thing is, recognizing that, businesses exist to make money, right? Businesses exist to make net income and deliver value to shareholders. And thinking about what is the path to doing that actually requires, I think, somewhat of an investor's mindset. And just, I think that's important, right? This is one of the things that is interesting, right? I think it used to be the case maybe 10, 20, 30 years ago where people think about CFOs or finance teams. It's just like, oh, okay, cool. They're bean counters, right? A lot of accountants, a lot of CPAs dominated by people who came from, the big four accounting firms, Deloitte, PwC, etc. And I feel like more and more that's becoming less the case because I think the finance function over time has become a little bit more strategic in thinking about, how do we actually address the levers and think about moving the business forward in the future. Right. And so it's a lot more dynamic. And, I would argue probably over time, it's required a lot more, higher order thinking.
I do look at my job in some respects as a resource allocation manager. I mean, I'm not making purchases of stocks, but I am making allocation and investment trade-offs between should we hire more people? Should we hire contractors? Should we get software to do it? So I do think there is an element of what can you learn from the investment side that can help you, allocate resources that go out and do stuff for the company.
Yeah, that's right. That's right. Coming back, almost full circle, right, to the discussion around risk. I think one of the things it is valuable to realize is that no business is a zero risk business.
Yeah, it doesn't exist. No.
If you take no risk, by definition, you should just own T-bills. That's the only thing, that's the only risk-free asset, right? And the reason why every business has risk is because you're always operating with imperfect information. You don't really know how customers will behave or competitors will behave or the regulators will behave or interest rates, right? Or the macro environment or stocks, right? Or anything like that. And so because of that, we're all just trying to do the best we can in terms of navigating a very uncertain world. And there's almost no function, in my view at least, there's almost no function within an organization whose job is to reduce risk to zero. Like, I think that would be wrong. Like, that would be very, very improper. I think it's more assuming you don't want risk to exceed a certain amount, right?
Yeah.
What is the best possible way to deliver shareholder returns? I think, a good general counsel should understand that, right? A good chief risk officer should also understand that, right? A good CEO, et cetera. I think they should all understand that, we're not here to run a zero risk business because that just, that's not really why we're here. But given the confines of the type of business we want to run, we want to make sure risk doesn't exceed a certain amount. And then what's the profit maximizing thing to do given some of those guardrails?
I love how you said businesses exist to make money, because sometimes I do think that we get too fluffy about it. And it's like, at the end of the day, dude, like it's here to print some money. And in order to do that, you have to sign up for some risks.
Yeah, that's right. That's right.
The businesses you've worked at, once you made the switch over to the operating side, Alex, were very much in the way of the money, as I like to say. How does being in the payments flow lend itself to value creation? Because you said businesses exist to make money. How does the value come out of being within the pocket, within the flow of transactions?
This is a mantra or a credo that I've held for quite some time. So in my view, he who owns the customer relationship tends to clip most of the alpha, tends to clip most of the value in the value chain. So there's that, right? If you own the customer relationship, the customer trusts you, right? That theoretically you should be getting a disproportionate amount of the pie. The corollary to that is, he who owns proprietary data, right, also should own the vast bulk or the lion's share of the economics in any sort of value chain. And so those are kind of two sides of maybe the same coin. Is if you own the customer relationship, theoretically that should correlate with you owning some amount of proprietary data, right, around either behavior or economics or market sentiment or anything like that. And I do think that folks in the payments space, almost uniquely sit in a very, very cool part of the value chain because you kind of see everything that goes in and out, and you can do a lot of interesting and cool things with respect to behavioral analysis. So that's kind of what how I feel like where value is most interesting and kind of the easiest place where it could be generated.
I never thought about it that way. And this isn't meant to be in like a nefarious way, but if you are in the payment flow, you do have asymmetrical information on what's going on both sides.
Yep.
And that can probably lend to some pretty cool opportunities of what products you should build next. It's kind of like you're pulling on the thread of being able to see more, and then it allows you to better inform your product roadmap. It allows you to better inform the risks that you want to underwrite.
That's right. I mean, I'll give you an example, right? Pull on that thread. So we know, like for decades, right? Hedge funds have done this. Every hedge fund does this now, where they would go to a large credit card, data aggregator, and they would basically say, I'm doing some work on Chipotle, or I'm doing some work on McDonald's. Show me all the receipts, all the credit card data, what demographic behavior looks like, city by city, region by region, what kind of menu items are more profitable than it. You can kind of slice and dice the data in a lot of different ways. Now, hedge funds use that data so they can better trade McDonald's stock, right? Or Chipotle stock. Great. Good for them. They just want to better understand consumer behavior. I think for a lot of, payments businesses and expense management companies and businesses, right, there's an additional layer, which is ingest that data, and sure, hedge funds will go and try to monetize that and just make money from it. But if there's a way to take that data and actually feed that back to the customer and say, hey, here's some observations we've made about your company, your business. Here are some ways in which we've identified, low-hanging fruit around how you can save a little bit of money or be a little bit more impactful. Or here we can automate this one random thing that's recurring and it seems like it's creating a lot of pain. Why don't we automate that away? Then all of a sudden, I think you are an active, member of the value chain where you're actually adding value as opposed to just someone who's almost, collecting rents, right? Collecting a toll, and you're just trying to make money from the value chain.
That's a good way to put it. You go from someone who's a gatekeeper and a toll collector, or they call it a tax. You never want to be called a tax in a business. That's when you're not like bringing value to the table. There are a couple of taxes I can think that we pay in my business. Then you go to a value creator, and people look at their relationship with you less so of a transaction. They look at it like a bundled value that they're getting.
That's right.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and Seat Geek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into Netsuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. Quick math, the less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to NetSuite by Oracle. NetSuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you reduce IT costs because NetSuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, wow, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. And back by popular demand, NetSuite has extended its one-of-a-kind flexible financing program for a few more weeks. Head to netsuite.com/metrics. That is netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please do it, guys. I really need this. Alex, can you think of any cases in your career in which you were the voice in the room as a finance person that was more risk on, that said, I think we should actually sign up for more risk here?
To be honest, generally no. Generally,
that's
no.
good too. Okay.
Yeah, generally no.
Trick question.
I do. Yeah, I mean, I do think that just given how businesses work and the world works, I do generally think that it is the role of a finance guy or that head of finance or whoever to be a little bit more on the less risk-seeking side of the house, and the reason is because almost everyone else is going to be pushing for more risk, right? So I have to be me so that you can be you, right?
Yeah.
Like there are going to be other folks on the executive team or on the management team who want to take more risk. All good, because that's your job. You should be pushing to do more entrepreneurial things or risk-seeking things, but I have to be me so you can be you.
I often say, Alex, I'm like, I get it, guys, but I'm the only one who's playing goalie here.
Yeah. That's right. That's right.
What did your time trading mortgage-backed securities teach you about risk and return? Any crazy trading stories there?
That's how I started my career. Thank you for asking that. So I started my career at Morgan Stanley, and then I went to Bain Capital for a few years trading mortgages. Those were a fun couple years, right? Because I graduated into the mortgage crisis. And so in those early years, it was really about kind of graduating into this crazy world where everything was undervalued. I mean, if you looked at the landscape in 2009, 10, 11, 12, everything was undervalued. I think it taught me a couple things. First, probably the most interesting thing I learned is that markets can be very efficient most of the time, but some of the time it can be extraordinarily inefficient. And all that means is that if you are a savvy enough guy and hopefully lucky enough, sometimes you can spot one of these massive opportunities and these massive dislocations and really make an impact and really benefit from that. I was always trained, from kind of studying economics and whatever in undergrad, I was always trained that, look, markets are going to be 99.9% efficient, almost always efficient. Right. And I think my professional experience has indicated that maybe it's not 99.9, maybe it's only 90%, right? That other piece of it can be quite compelling and quite large.
Why was everything so mispriced? Was it just because people were like snake bitten by what had gone on?
100%. Just to give you some context, like during those years that I just named, right? 9, 10, 11, 2012, during those couple of years, first of all, no one was buying houses, right? No one was buying mortgage-backed securities. No one was really taking any risk because I think people were very gun shy from having just lost a ton of money. I mean, almost categorically across the entire investment community, right? People were very gun shy about, investing. And so there were, incredible opportunities within within this space. Not to get overly technical, but my friends and people, even former coworkers know that I love CLOs. I love CLOs, collateralized loan obligations, right? It's a little bit of a dirty word because it's like, oh, isn't that the thing that blew up back in 08, 09? And why are you talking about it?
That was a flavor of them for a specific asset.
Yeah. I mean, the funny thing is, in 2008, 2009, there actually wasn't a single CLO, like AAA, bond that lost money. Not a single one. Like, it was an unbreakable structure. Anyway, I'll step off my pedestal now. But all that is to say is, a lot of the times, right? I mean, this is the expression of, throwing out the baby with the bathwater,
Yeah.
right? Or this is exactly that. Is that oftentimes there are pockets of interesting assets and interesting value, and for one reason or another, just ignored by the market, right? So, I would say oftentimes stuff like CLO AAAs exist that are, unbreakable structures and extremely safe, but oftentimes they would still, be sold off, trade at very high yield, and you're just like, wait a minute, that doesn't make a ton of sense.
I feel like you are a man who has an opinion on the rating agencies. Do you think that it's pay to play? Do you think that they're real? Like, what's going on there? Because I actually feel like there are some stocks out there with a lower rating than the US government bonds, and I would actually bet on them to be around longer than the US.
Honestly, I actually don't have a strong view. Ratings agencies, I think they perform an essential role. An essential role in the capital markets world. I think they have an impossible job. Their job is very, very difficult, right? Because they're supposed to be the arbiters of, what is safe and what is not. But, theoretically, in an efficient market, the market should do that, right?
Yeah.
I mean, if stuff trades very cheaply, that's more risky, et cetera, et cetera. You shouldn't need the ratings agencies, but you do, right? For investor protection, for disclosure, for regulatory, et cetera. I think honestly, overall, I would say over the course of my arc of my career, I think I've found that they play a very essential role. I think for better or for worse, they don't do a perfect job, but it's kind of a thankless job, and it's very, very difficult.
I'm thinking of the scene in The Big Short where they go into, and I don't know if it was Fitch Ratings or what it was, but they're talking to the woman who's basically like a librarian, and she's dusting off the books to check the ratings. And then she's saying, oh, well, we can't rate them that way because they're essentially our customers. And I was like, whoa, this system's a little wacky.
Yep. So post, GFC, like post 2009, that is less and less true, which is good, right? That they're regulated now much more rigorously than before. But yeah, you're right. It's tricky, right? It's tricky. I spent a lot of time with the ratings agencies myself. Yeah, it's a tough job.
This next segment, I'm going to call it Storytime with Alex. So I'm going to throw out some keywords, and you can tell us the significance or a story. You'd put this in the brief, and I'm just very fascinated on where this will go. Something called seismic shipping. What's that?
Yeah, seismic shipping. So this is years and years ago. Years and years ago. I was working at a private credit hedge fund, and we were looking to finance very esoteric one-off assets, right? And basically, there were these billion-dollar ships that all they did was one thing. They were seismic ships that evaluated kind of the crustal composition of the earth to tell oil companies where to drill for oil and natural gas. Whoa. Right? And these things were expensive. I mean, they cost like $1 billion to build, right? And you need financing for that. And so banks or hedge funds or insurance companies need to go and lend money for construction financing, stuff like that, et cetera, hundreds of millions. What's interesting there is, going back to just, the efficiency of markets, right? And taking risk. Like, I'm more than happy to finance something like just like a warehouse, right? Because a warehouse, I can sell that to Amazon. I can sell that to whoever. It's just a box in the ground, right? It's kind of fungible. You can do a lot of things with it.
I can offload that.
You can offload that like that, right? Something like a seismic ship, my God, multiple $100 million. And in the world of oil drilling, there's probably 10 companies on the planet who can afford something like that.
How many buyers you have for that thing?
Exactly. That was a fun, little investment that we underwrote, quite a number of years ago.
You forget that all these rare asset classes need some banking partner.
Well, credit is what makes the world go around.
All right, next one here. Rough diamonds.
I love this deal. This was probably one of my favorite deals to diligence. But long story short, again, this was many years ago. I learned a ton about the supply chain for diamonds. So where they're mined and who mines them is a very interesting case of what's known as a duopoly. Alrosa and De Beers are like the two largest,
Yeah, I've seen blood diamond.
Right. And then you've got guys who polish these rough diamonds. It turns out that's also a little bit of a cartel, a little bit of an oligopoly. And it's dominated by a bunch of different, almost family businesses. And the deal that I was looking at specifically was one of these families, wealthy, diamond family. They basically want to securitize their rough diamond supply. They wanted to literally take thousands of diamonds and borrow against it, and then subsequently finance more diamond purchases from De Beers and Alrosa and those guys. And then what they did was basically they polished them and they would sell them to like Tiffany's or whoever. And so they're clipping almost like a spread, right? By polishing rough into polished, they're clipping a spread. And by levering that, they were able to get a higher return on equity. What's interesting is this. This had never been done before because these are family businesses. They're run very conservatively. No one for hundreds of years had even thought about levering these businesses. They just didn't take on debt. And so this one guy was like, why not? The margins I make are so high. My supply is regulated. My demand is also regulated. And my margins are extraordinarily predictable. This is an amazing asset to sort of lever up. So let's go. So spent a little bit of time on that as well. I got to know actually some really interesting characters, colorful people. I met some very senior executives at De Beers as well, and some of them are still friends. And so, yeah, very, very cool.
What was your takeaway on the diamond industry? Was it completely unique to any others out there?
I think it's an amazing industry. Like I just every part of the value chain, I'm just like, this is an insane industry. I'm not surprised that it makes a ton of money. I'm not surprised that it holds a very, very special, position in our society.
My mother-in-law, shout out Denise, she's in the jewelry business and she's obsessed with lab-grown diamonds now.
Absolutely. Absolutely. Here's what's interesting. A lot of the largest labs, kind of just interesting side note, a lot of the largest labs that create lab-grown diamonds are actually owned by De Beers and Alrosa.
No way, because I thought they were actually like messing up what they had going.
Industry consolidation. My hypothesis is that a lot of the traditional miners, they acquire the labs, and then what they do is they pump the market full of very cheap diamonds. Meanwhile, they're going to take traditional diamonds or mine diamonds and take those prices up, almost to create two different non-overlapping segments of the market so that they don't cannibalize each other.
There we go. It's actually making the pie bigger when you think about it that way. It's not cannibalizing, traditional diamonds with lab grown.
Just one person's pet theory. I'm not sure if that's actually true.
This is cool. All right. This next one, I don't know where this is going to go. Colombian litigation finance claims.
Again, an investment I looked at a number of years ago in one of my prior jobs. But basically, the world of litigation finance is kind of interesting. It's another asset class like anything else. It's tradable. You can finance it. But basically, in Latin America, not just in Colombia, but in Latin America, you can actually have a judgment or a claim against the government, the municipality, and the state, et cetera, et cetera. I mean, these exist everywhere, right? But in a few different countries, these claims are actually very liquid, well regulated, and tradable. And so what that means is, I could actually go to, let's say, a sanitation company, right? Maybe there's a municipality or a state that a sanitation company is like, well, you owe me money. You owe me, $100 for the last month for my work. And that claim, it's almost like an invoice. Like you can almost finance it like an invoice. And so I'm kind of oversimplifying things here a little bit, but basically there are hedge funds out there who would literally purchase these claims, right? And then they would oftentimes try to collect. This happens in the US as well, but in the US, it's a little bit, I think, structurally, I think there are parts of the market that are much less well regulated than in other countries.
I didn't know you could buy litigation claims. So in the US, I see tobacco settlement claims. Is that one that you could get involved in potentially?
Also very well trafficked by hedge funds. But the most popular one, just in case, something, maybe like a bedside reading or something, the most popular one in the US is probably the state of Illinois.
Huh.
Historically, the state of Illinois has had claims that were actually relatively well understood, well priced, and regulated, and that was tradable as well. So there was a time, I would say maybe 5, 6, 7 years ago, ish, maybe 7 years ago, where these claims were traded by a lot of investment banks and a lot of hedge funds. You could like take a view on the fiscal condition of the state of Illinois.
Alex, I feel like you must have the most interesting YouTube history out of anyone.
Maybe.
All right. Land lots. What's going on there? Was that another investment?
That was another investment. That's probably the biggest investment, I ever, managed, I would say, in my career. So this was going back to my mortgage roots, right? This is going back to my mortgage roots. I love housing. I love the real estate market. I loved mortgages. And this was during the boom, right? When kind of after the crisis, the market had recovered. And as you know, the last 10 years, it's just been a raging bull market for real estate. And so one of the investments I managed was basically, we went and we purchased several $100 million of land rights, like almost like land, right? And then we slowly sell it to the large home builders, Lennar, Pulte, Toll Brothers, etc. And there was a little bit of financial engineering involved, but home builders are having an absolutely, banner decade, right? They just, can't build enough houses, there's a lot of housing constraint. And so if you own the land, you were able to be, a part of the value chain there in terms of, managing their balance sheet, managing their risk, etc. That was also a fun investment as well, because I think I literally got to travel to, 40 different cities, kicking the tires, figuring out local markets, picking out real estate, doing a little bit of mystery shopping. Like the number of model homes I visited over those couple of years was pretty insane. I got to know guys relatively well, like literally just salespeople, Taylor Morrison, Pulte, et cetera, et cetera.
That it brings me back to that John Paul Getty quote. It's the meek will inherit the earth, but not its mineral rights.
Mm-hmm.
All right, we got a couple more here. Rail cars. Did you buy rail cars too?
Rail cars is actually, among all the things on this list is actually almost the easiest one to think about. So okay. Rail cars are cool, right? Rail cars are cool because they're kind of like solar panels. They exist for a long time. They're made of like steel and they don't really go away. Like you can use them for 30, 40, 50 years, right? And they just have a long life, long useful life. And so what that means is these rail cars, right, are like basically the opposite of seismic ships, right? Seismic tankers.
A big market to sell to. Yeah, you can put anything in it.
You just grain, oil, whatever, Canadian oil sands, whatever, my t-shirts, right? And so what that means is long useful life, pretty usable, pretty fungible, which means you can securitize them pretty easily. So you can take these rail cars and you can lease them to any of the rail companies or any of the retailers or whoever the case might be, an agricultural company. And then because the lease payments are recurring in nature and you're facing very creditworthy counterparties, there you go. If you're a hedge fund, you're going to go and securitize that, right? You're going to try to make, a market out of rail cars as well. And so there's this whole asset class of transportation assets that all behave like this. Again, something I didn't know before really delving into this market, but aircraft engines trade like this. Aircrafts trade like this. Solar panels, like I mentioned, right? Again, very long useful life type stuff. Verizon used to put out a bunch of securitizations where it's literally phone, handsets.
One of the most interesting securitizations that I've seen, if that's a word, is how all the artists are selling off like their back catalogs.
Yep.
What do you think about that?
I don't know how spicy I'm allowed to have a take. Am I allowed to have a spicy take on your podcast?
This is what the pod's for, man.
So the art world is extremely unregulated.
Yeah.
For better or for worse, it's extremely unregulated. And so what I think there's a lot of players in the space who are extremely predatory. And I think that a lot of the kind of fractional art or the securitized art and the stuff that you see, particularly platforms that cater themselves to retail investors.
I know exactly what you're talking about right now.
I think that a lot of the times, probably these investors are not going to make a lot of money. I just think that there's there's not a lot of protections there. Now, if you're Carlyle and you're running like a $500 million art fund and you're trading art and you're doing all that stuff, they're going to do great. They're going to do great.
I went down a rabbit hole of like buying a portion of like songs from artists that I like. And then I backed out of it just because I'm like, is this ever going to see the light of day? Like, will I ever actually make something off of this? And I just felt like the greater fool in it. But I wanted to like it so bad.
I think my take here is this is not yet a mature enough industry. And I think it's best to leave this one to the institutional investors. So like KKR, for example, very famously, they've purchased billions of dollars of catalogs and assets and companies that do music royalties. Like, I would be very happy, like, if I were an LP of KKR, great.
Like they're going to do it right. Yeah.
Yeah, they're going to do it right, and they're going to protect themselves and protect you as a shareholder.
That's a great perspective. Dude, you can securitize anything. That's kind of wild.
Assuming that it's a mature enough market and you have the legal and regulatory stuff figured out, generally, yes. And by the way, here's why. It's not because of, you've seen The Big Short. A lot of people have seen The Big Short, and it's just like, oh, these guys are just preying on investors and they're just trying to make money and whatever. The truth of the matter is, I think nowadays the market's really evolved past that. The reason why you would securitize assets is generally just to create more liquidity in the market and just help companies find cheaper sources of financing, right? And so, and those cheaper sources of financing are not going to be you and me. It's not going to be retail, right? It's going to be very smart, very savvy sovereign wealth funds and insurance companies and pensions and whoever. And it's almost kind of like these guys are going to do a good job of taking care of themselves, right?
Yeah.
So I think my view is actually, at one point it may have been kind of cynical, right? But I actually do believe the world has, gotten to a pretty good place, within the structured finance securitization world.
Wherever there's innovation in this space, there always will be this gap in which there is a predatory period because it does attract grifters and the like. But over time, there always does seem to be like a second or third rebirth of it, and then it becomes more standardized and it's okay to participate in.
I think that's right. Yeah, I think that's right.
All right, Alex, I'm going to take you into what we call our long ass lightning round. So what's an example of something you've screwed up on the job? It could be at any role you've had in the past.
That list is very long and very extensive. But I think that's a good thing because you learn, but I will tell you, when I was 23 years old, first job ever out of school, I was at Morgan Stanley. And I feel like when you work on the trading desk, everyone has to do this at least once, but I fat fingered a trade. Like I fat fingered a trade as like a second year analyst, right?
Like you added an extra zero?
It was something like that. Either I added an extra zero or I hit the wrong key and I sold some bonds or bought some bonds at just very obviously not the right price, right? I just remember, like, as a 22-year-old, I was just like, yeah, I'm going to get fired. I'm going to get fired today. I'm going to lose my job. I'm going to lose my livelihood. I'm going to have to move back in with my parents, all this stuff.
Yeah, you immediately go to that too, the worst case.
Yeah. And at the time you think, wow, this is like the worst thing that's ever happened to me, ever. I think it's just interesting to keep things into perspective because now I could happily say that now that I'm like, 15 years out from that moment. But at the time, I went to my boss and he was like, wow, that was dumb. I can't believe you did that. And then it was a little bit of like, made a phone call. 2 minutes later, it was like, it's all good. We reversed that trade. No harm, no foul. He moved on with his life. Like he was thinking about a million other things, right? I obviously dwelled on that for a long time. And I think that's one of those things that comes with experience, where like with experience, you can kind of put something like that into perspective to kind of know like how grave, like how significant is something actually in the grand scheme of things. So I don't know, maybe just like an interesting lesson learned about just having been in the workforce right now for, well over, a decade and a half.
That's a great one. And we've all been at that point where you look back at this one microcosm of your career and you're like, at that moment, I thought I was going to be unemployable forever.
Yeah. I thought I was going to die. And then it was like, no, like actually nothing happened. Like literally nothing happened.
Yeah. I had an experience, first job out of college. It's not as cool as trading or anything, but like I remember at PwC, I was responsible for booking like an outing for 20 people, and we rented out an entire like 3 bowling alleys in downtown Boston on a Friday night. And we were coming back from a trip, and I was heads down working on the project with my manager, and we're in the cab. We just landed at Logan Airport, and the bowling alley calls me, and it's like the one right next to Fenway. I think it's King's or Jillian's. And they're like, hey, we're expecting your party of like 20 or 30 people. Where is everyone? I completely mixed up the dates and didn't tell anyone about it. And I think I burnt like $5,000 on it. And at that moment, I'm sitting in the cab like, this is how it all ends. This is going to be my first and last job. And I told my manager who's in the cab with me, he's like, all right, let me call the partner. And so he calls the partner, tells him, he's like, okay, no worries, hangs up. And it was like the same thing. Like he'd already moved on to the next thing. And I'm sitting there like I completely effed up and no one's ever going to hire me again.
Actually, I can imagine how you felt because like that, everyone needs to go through like a formative experience like that. So I can imagine how crazy that must have been.
Can you tell us a story about either buying something or a negotiation gone good or bad in your career?
My thinking on that has evolved quite a bit over time. I think that, early on in my career, I thought about negotiations very much in like a zero sum perspective. But I think over time, I have become a little bit less of a hard ass, and I try to be a little bit more collaborative when it comes to negotiation. I do have like my experience I think at Ramp to thank for a lot of that, because genuinely, like over the course of my last 4 years at Ramp, I mean, we did have a lot of really good commercial partners.
Well, we've only been on this for an hour getting to know each other, but I feel like you're a pretty good negotiator.
One of my closest mentors, someone I used to work for a number of years ago, he gave me some really good life advice. This is a few years back, which is, Alex, like what we do, it is, we're not saving lives, right? And by the way, if you're a doctor, this advice does not apply because you actually are saving lives. But for us, right, it was, for finance guys, right, for finance guys and whatnot, we're not really saving lives. And so, don't worry about it. I think that was kind of his advice. Like, be a good guy, be a good person, try to be collaborative. Yeah. And if you win some, you lose some, kind of all balances out in the end. And, as long as you're a good guy, life is long and careers are long, right? And people will come to appreciate you as, a strong partner, as someone they genuinely want to hang out with. And, I would hope that that's like, what I leave people with after a negotiation had been done. And so I do think that, what we do is not, curing cancer, and it's not saving lives, and it's not, jumping out of, a burning building or anything. And so, I think that having like that sort of perspective can give you a lot of, can alleviate a lot of the mental angst around, negotiations, right? Or asking for stuff.
Yeah. And then you stop thinking about it like a binary win or loss too, when you know that it's not life or death.
That's right. I mean, I would say some of our major commercial partners just over the last, couple of years, genuinely, I would say some of them are folks I really enjoy. I consider them to be, awesome people. And even though you would think on paper, right? Wow, every couple of years you have to, fight each other for bips, right? You have to fight each other for dollars and cents. But there is an element of that. But at the end of the day, like these relationships are, last decades, right? And every negotiation is a battle in a very long and protracted, engagement.
All right. Last one I got for you. What's the craziest thing you've ever seen someone try to expense? This may be even more of a meta question because you worked at a company that allowed people to expense things.
I mean, this obviously, I can't give too much away, right? Just because there's a lot of proprietary data.
Hypothetical.
Yeah. No, look, I will say there was definitely a lot of funny transactions. So I will tell you about one. I think at one point someone tried to purchase an airplane ticket. Oh, by the way, this is not inside Ramp. This is actually just, a person, a card holder, right? I think at one point someone, of course, right, tries to travel and try to purchase an airline ticket. And there must have been a crazy fat finger or some sort of data error and whatever. And what was supposed to be like a $400 transaction wound up being like a $400 million transaction. And of course, every possible guardrail like went off and every possible warning sign. Of course, this transaction was not approved. I mean, just
were they buying the plane? I don't know.
So it was funny because that was the running joke. We were just like, were these guys trying to buy an airline? Or are they trying to buy a plane ticket? But that was just a funny story that, it wound up being nothing. Like literally it wasn't anything. It was literally just a faulty kind of data point that, again, like tripped every possible, warning signal and whatnot you can imagine. And this transaction was never going to be approved, obviously. But we just remember seeing this massive decline, and we're just like, okay, well, that transaction was declined. I guess someone tried to buy an airline and couldn't do it.
That's crazy. So I had experienced somewhat like that, where I have a newsletter, mostlymetrics.com, and they had this like founding tier plan. So when I turned on paid subscriptions, if you wanted to, you could be like, hey, it's $150 a year at the time. I want to do $200 because you're such a great guy. Somebody put in $212,000 and it went through.
Yep.
I don't know how it went through on a credit card.
Wow.
And I don't want to keep the money. So I try to give it back, and then Stripe's going to hit me with like a $30,000 processing fee.
Wow.
And this is on day one of turning it on. So I'm like completely like, what the fuck did I just do? Like now I went from like maybe making $1,000 this day to being like $30,000 in debt and like this entrepreneurial, like small, like venture here. And, luckily the people at Substack helped me out, but like I called them in a panic. I don't know how this went through. Like, I'm not trying to take this guy's money. It's not fraud. Like, can you just like take this money away from me? But like, I can't afford this processing fee. And so they helped me out. But, and then I emailed the guy and he didn't even know what happened. He's like, I have no idea what happened. Like totally cool about it. And I was like, how is your credit limit this high? How do you have a corporate card that lets you do $200,000 easy?
That is so funny. I would love to know what went on behind the scenes, because you're right. Like normal credit cards, right? First of all, normal credit cards have a whole host of guardrails and limiters and throughput and velocity and, dollar per unit time. And so I would love to know what happened behind the scenes.
He was a CFO too. I won't say what company, like governance over there.
There you go. That's a funny story.
Yeah. Alex, this has been a blast. You hold the trophy for now for world's most interesting podcast guest. And I hope to have you back on at some point in the future.
I appreciate that. Thanks again for, giving me the opportunity. It's been great.
Run the Numbers is a Mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.